Well, good morning or good afternoon, depending on where you're joining us from. Welcome to today's webinar, which is going to be an Unemployment 101 session for nonprofit employers. Couple of housekeeping items. There is a copy of today's presentation. You can find that located in the resources section of the toolbar. So feel free to download a copy of that. Also, I'm going to leave everybody on mute to keep down any background noise or distractions. But if you have a question, feel free to type it in the Q&A box, and I'll stop periodically throughout the webinar to check that. Of course, you can always reach out to us offline after the webinar as well. And then if you are here for the continuing HR credits, so either the SHRM or the HRCI credits, in order to get those, you just have to fill out the survey that you'll receive after the webinar. And once you fill out that survey, give us about 24 hours and we'll make sure we get you the codes for those credits. My name is Nicole Korn, and I'm the Director of Unemployment Insurance Solutions here at 501, and I'm going to be your presenter today. As far as the agenda goes, we're going to first cover some foundations of unemployment and kind of how that program was built and structured. Then we'll talk about chargeability and liability. Then we'll move on to the types of separations and various adjudication tips and strategies. And then we'll wrap up with just some quick tips for appeals and hearings. All right, quick history lesson. Unemployment all began with the Great Depression. In 1929, U.S. financial institutions collapsed and many companies laid off workers, which caused the unemployment rate to skyrocket to almost 25% nationwide. So it was this event that prompted our government to find means to provide relief to these impacted individuals who had lost their livelihood. So on August 14th, 1935, President Roosevelt signed the Social Security Act, which contained provisions for elderly insurance, welfare, and unemployment insurance. Now, the U.S. unemployment program is federally mandated. However, the individual states are free to administer the program as they wish, so long as they meet 4 federal requirements. So the first requirement is the replacement of lost wages. And the main objective here is to protect workers from a temporary loss in wages. And while the benefit amounts that people can collect vary from state to state, unemployment is always meant to replace only a portion of a worker's earnings. Usually it's around 50% of what they make on average every week, up to whatever the cap or the threshold is in your state. So for example, if a worker makes $1,000 a week while they're employed and they get laid off, they're not going to make $1,000 a week in unemployment benefits. They'll probably make somewhere around $500. And this is in part to provide an incentive to that unemployed worker to return to the workforce. The second federal requirement is stabilization of national employment. And so this objective creates an incentive to the employer to retain their workforce by taxing them or charging them on their prior unemployment experience. The next one is stabilization of the economy. And the objective here is to retain some of the consumer purchasing power and hopefully prevent an economic downturn. So in other words, if someone has no money coming into their household, they're probably not spending a lot of money out in the economy. And this happening a lot could create a cycle and an economic recession or downturn. So the idea is to prevent that. And then the fourth and final requirement is actually job placement. And this is why the state unemployment agencies are the #1 job placement bureaus in America. Now, outside of these 4 requirements, each state administers its own program, and this is why regulations regarding eligibility, benefit amounts, and the length of time that someone can collect is going to vary by state. However, when it comes to eligibility, there are 5 criteria that are consistent in every state. In order to be eligible to collect unemployment benefits, you must be able to work, so physically able to perform some kind of work. So you can't be on disability and collecting unemployment benefits. You have to be available to work. So you can't be, in college full time or in Europe on a vacation and drawing benefits. You have to be available to accept work. You have to be actively seeking work, which is like applying for jobs and things of that nature, attending interviews. Then you must meet the state's monetary requirements. So what this means is you had to have worked long enough or been in the workforce long enough to have earned enough wages to meet the minimum thresholds to be eligible. And then last but not least, you must be unemployed through no fault of your own. And this one is highly subjective, and we're going to talk more about that when we get to the different types of separations. So, unemployment program really had not changed much since 1935. That was until President Obama passed the Trade Adjustment Assistance Extension Act of 2011. This was major legislation that resulted in new regulations to promote unemployment insurance integrity. These new regulations went into effect in 2014 and changed the way that employers need to view their role in the process. So previously, employers made a choice between responding or not responding to unemployment claims and would often only respond if their wish was to have the benefits denied. But moving forward, employers are actually required to respond to all claims to remain in compliance and avoid potential penalties. This federal legislation stipulated that the state unemployment agencies must prohibit relieving the employer of charges when both of the following conditions exist. So, if unemployment benefits were paid improperly due to a failure of the employer to respond timely or adequately to the state's request for information, and number two, if the employer has a pattern of doing this. And what constitutes a pattern? It could be, it varies by state, but in general, it's 2 instances or 2% of all of your claims in the prior year would sort of put you on that non-compliant naughty list. So what does this mean? Exactly. Well, prior to 2014, employers could just send a very generic response to an unemployment claim. And if the person was awarded benefits, they could appeal it and then put the effort in to gather all the details and supporting documents for the hearing. If they were successful in getting the decision overturned at the hearing, the state would then owe the money that had been paid out already back to the employer, regardless of any fault that they may have had in the state making an incorrect decision. Now, post 2014, the states are required to deny the reimbursement of those improper payments if the employer has a pattern of doing this. They may stop paying benefits as of the hearing decision if you get it overturned, but you're not going to get back any of the money that has already been paid out. Now, these rules are actually beneficial for all parties involved. If you provide the necessary details and documentation up front, the state will make better initial decisions, which then results in less appeals and hearings for both of you and both you and the claimant, and the states are less likely to become insolvent because there will be less improper payments being made. And if you think about it like this, an individual could collect thousands of dollars by the time the claim gets to a hearing. So if you wait till the hearing to provide all of the necessary information that you should have provided, which would have initially disqualified the person, the state now has to go and try to collect all of that money back from someone who is currently unemployed. And in most states, the employer does not get their money back until the state recoups it. And I've seen it take 5 to 7 years. And sometimes they just end up waiving the repayment of those benefits due to hardship. So it really is in your best interest to respond to all unemployment claims timely and adequately so that the state can make good initial decisions as they are applied to the law. Unemployment claims are 100% funded by employers, either through taxes or direct reimbursement. It is not uncommon for employees to believe that they pay into unemployment and it's a benefit or an entitlement that they're owed, but this is not the case at all. There are 3 states that do require a small employee contribution. The states that I'm aware of are New Jersey, Pennsylvania, and Alaska. However, these contributions go directly to the state for the cost of administering the unemployment program and does not contribute to the funding of the unemployment benefits. The benefits are 100% paid by employers. So when it comes to funding these benefits, there's two types of employers. You could be a merit-rated employer, which means you're a tax-paying employer, or you could be a reimbursing employer, also known as a self-insured employer. So merit-rated employers could be a for-profit company or a nonprofit. They're going to be issued a tax rate every year in each state that they operate in. That rate is then going to be applied to a wage base that varies by state. So, for example, in the state of Oregon, the taxable wage base for 2024 was $52,800. And you could be assigned a rate up to 5.4%. So let's just say you're assigned a rate of 4% this year. That means you're going to pay 4% on the first $52,800 that each employee earns. So that's a maximum of $2,112 per employee. So say you have 100 employees, that could be as much as $211,200 that you're going to pay this year, regardless of whether you've had a single unemployment claim. And when determining your rate each year, there are a lot of socialized costs associated with that. So it's not just determined by your own unemployment usage or experience. You could be doing great, but other employers in your state are not, and so your rates could go up just due to that. Plus, most states use a look-back period of 3 to 5 years to determine your rate, so one bad year could affect your rate for several years after. Now, conversely, the other type of employer is a reimbursing or self-insured employer. To be eligible to do this, to reimburse, you must be a 501c3 nonprofit organization, a government agency, or a tribal organization. So you have to meet those criteria to even be eligible. Now, being a reimburser can be particularly advantageous for several reasons. You will pay only for actual benefit payments issued. You will avoid increased tax liability due to an unfavorable economy. You will avoid the tax assessments and socialized costs that goes into those rates. I know that it may have seemed scary to be a reimburser during the pandemic. Thankfully, the CARES Act got all of that relief and everything. But post-pandemic, nonprofits or just, reimbursers in general are seeing historically low unemployment charges and claims, right? Claims are down as to where they've been historically. And so reimbursers now are enjoying that benefit of only reimbursing the state for actual benefits used, while tax-paying employers are paying more and more taxes to try to refund the systems that were depleted during the pandemic. This is just kind of an FYI. I think it's interesting. Most studies that attempt to quantify the cost of turnover usually look at the cost of hiring plus the cost of training a new employee, but very rarely do they consider the cost of an unemployment claim. And they really should, because it directly impacts your bottom line and it is somewhat controllable. I mean, look at the state of Washington. One claim in the state of Washington could cost you as much as $28,054. All right. Let's talk about chargeability and liability. One of the questions that we hear a lot: why am I responsible for this claim? And how much am I going to have to pay on it? Or how much am I responsible for? So let's talk about how the state does this. So the first thing that the state will do, and this is all states, when someone files an unemployment claim, is they're going to determine something called the base period. In the majority of states, the base period is going to be the first 4 of the last 5 completed quarters. The exceptions to this are Massachusetts and Minnesota. They use the last 4 completed quarters, but most states use the first 4 of the last 5 completed quarters. So this chart here is meant to show you how to figure out the base period. So the arrows pointing to the unshaded boxes, that would be the period in which they filed the claim. So we're in the month of November, so that's going to be that bottom right unshaded box there. So this is the quarter we're in here, and it's not a completed quarter. The base period is going to be the first 4 of the last 5 completed quarters. So the previous quarter to this quarter, you can see, is blank. It's called the lag quarter. That quarter is not included in the base period. And you'll see the 4 quarters prior to that is shaded. That's going to be your base period. So the base period would be July. So if someone filed a claim today, base period is going to be July 2023 through June 2024. And the base period is going to tell the states several things. It's going to tell them, has the claimant met the minimum wage requirements? So we talked about that monetary eligibility earlier. So they're going to look at all the wages that were reported by employers during that shaded period. It's going to tell the state how much is the claimant eligible to collect and for how long. It's going to tell them which employers will receive a claim and what types of claims they'll receive. And it will tell them if the claimant is found eligible for benefits, how much will each employer pay? So base period is extremely important in the unemployment program. So let's go through a specific example. So in looking at this graphic, you will see that there are 3 companies involved in this claim. So if you kind of look, you got your claim filed date, and then you've got your lag period, and then you've got the base period. Now, by the way, the point of the lag period is because because you might be thinking, well, I don't understand why this is even there. Why don't we do it like Massachusetts and Minnesota? The reason for this is actually pretty important. So employers have on average about 30 days at the end of each quarter to report their wages to the state. So if someone files in the very beginning of a quarter, it is very possible that they would not have the wages yet for the previous quarter. So in states like Massachusetts, if that happens, the employer gets a really annoying manual wage questionnaire that they have to fill out. So in my opinion, the lag quarter makes total sense. It gives employers time to report all that data and avoids unnecessary manual questionnaires. That's just a duplicate of, it's duplication of effort. So the lag period makes sense. Okay, so below the graphic here, you'll see there are 3 companies. We have company A, company B, and company C. So company A is going to be both the last employer or the separating employer, and you can see that they have a little bit of time there in the base period as well. So they are both last employer and base period employer. Company B, they are a base period employer only, and company C is also a base period employer only. So company A would receive a last employer claim, which is used to determine the individual's eligibility based on their most recent separation. They will also receive a base period notice because they have wages in the base period, which is also known as like the chargeable period or the look back period. So the base period notice is going to address their financial liability. So then you've got companies B and C, and they will both only receive a base period notice letting them know that they have liability and will be charged their share if the claimant is found eligible based on the reason for separation from their most recent employer, in other words, company A. In general, base period only claims are not protestable. Now, there are some state exceptions, which I'll cover on a later slide, but for the most part, if you are a nonprofit, these base period claims are non-protestable. And the reason for this is because since you only pay for actual benefits used, and you don't pay into that socialized pool of taxes and all of that, there's no money to pay this person otherwise. So what I mean by that is if someone leaves your organization and maybe they quit, right? And so, but they didn't file a claim at that time. They went and worked somewhere else, and then that employer, maybe 6 months later, lays them off. Well, that's of no fault of their own, right? They're laid off. The state's not going to disqualify them from some of their benefits just because they quit your company. It wasn't that quit that is what prompted them to file the claim. They were legitimately laid off. And so the way this works with tax-paying employers is, well, in both scenarios, if the person's eligible from their separation from company A, they get their benefits. But with a tax-paying employer, they can get relief of charges from their experience rating when they're a base period employer only, because the state can take those funds out of that socialized pool. Whereas if you're a reimburser and you only pay for actual benefits issued, they don't have a pool, and so you'll have to pay your share. So that is one difference between being tax-paying and being reimbursing. Now, in this example, the wages reported to these three employers, we're going to say it was $50,000. So in that shaded period, that gray period to the left. If the claimant is found eligible, then their weekly benefit amount would probably be somewhere around $480 a week. Now, 36 of the 50 states charge proportionately based on the percentage of wages that each employer paid. So in this example, right, and this is a proportional example since that's the majority of states, you can see that company A paid 10% of the total wages. So they're going to pay 10% of the benefits, or $48 a week. Company B paid 20,000 of the 50,000, or 40%, so they're going to pay $192 a week. And then company C paid 25,000, or 50% of the total benefits, and so they're going to pay $240 a week. Some other examples of the way states do charging would be, there's two other examples that I'm aware of. Illinois charges the last 30-day employer that also had wages in the base period 100%, or if you don't have wages in the base period, they charge you 50%. But it's always the last 30-day employer that gets charged. And then there's a couple other states like Iowa and Massachusetts that do inverse chronological order. So in that example, this $480 a week, let's say that, again, so $480 a week, and let's say they qualify for the maximum 26 weeks, right? That would be $12,480 total. And so let's say, your company C, or well, we'll start with company A because they only paid 10%, right? So basically that's $1,248 of the total claim. So what they would do is they would start with company A and charge them $480 a week until they hit that maximum of $1,248. And then they would move to company B and they would start maxing out their liability, and then they would move to company C, which I think is actually a pretty interesting way of doing it. It makes a lot of sense, right? That way, company A, the person responsible for the claim, starts getting charged first, and then that way, if the person goes back to work, companies B and C may never get charged at all. So that is a very interesting way of doing it, but I'm only aware of a couple states that do that. We talked about those base period protest rights. And so I did say that there were some exceptions to that for nonprofits. I've listed them here on these two slides. These are the different rules about that. I'm not going to read them to you. You can download the presentation and you can look through and see if your state is there. But just like as an example, like Iowa, again, they let nonprofits protest all claims, including if you're not the last employer. So you can protest base period claims in Iowa. States like Pennsylvania, they'll send you a solvency fee notice every year in November. And so that notice basically says, here's the one-time fee you can pay to have some protest rights next year on base period claims. So basically you're creating sort of that pool that gets created in the tax system, but you're just doing it through like a direct payment. So that's another option there. So yeah, there are some exceptions. So feel free to download this and look through that. All right, I'm going to check the questions box before we move on. Okay, easy enough, no questions yet. All right, so now we're going to talk about the different types of separations that can occur, what type of documentation you should be collecting to support, these various separations, as well as how they're adjudicated. First thing I want to say is that the time to win an unemployment claim is not when you receive notice of the claim, right? The time to win it is before that person ever leaves your company, before they're ever separated, because once they have been separated, it's too late. You can't go back and create that written paper trail, those documentation and warnings. You can't go back and request the resignation letter that you should have gotten before they left. So it's really important to be thinking about these things along the employee life cycle. And that's what we're going to focus on, winning the claim before it's ever filed. So there are three types of job separations that are recognized in unemployment adjudication. Every separation is going to fall into one of these three categories. And the type of separation that they determine, it being which category, is going to determine and dictate the flow of how the claim is adjudicated and who has the burden of proof. Okay, so they're going to look at things like who was the moving party that initiated separation, Was continuing work available had, this person not quit or what have you? And so basically what I want to do is kind of go through each of these types and kind of explain how the state views each one. Most of these categories are pretty self-explanatory, like obviously a discharge if you fire somebody for misconduct or a violation of policy, that's pretty obvious. But what you may not realize is suspensions and like mutual agreements, which a mutual agreement is simply, I'm going to let you quit instead of being fired kind of a thing, or, hey, this just isn't working out, let's part ways. Those are going to be adjudicated as discharges, okay? Because the employer is going to be the moving party in that, and continuing work would not have been available otherwise. So like in a mutual agreement, if that person hadn't quit, were you going to fire them anyway? The answer is yes. It's not a quit, it's a discharge. Voluntary separations. Obviously, if someone quits or stops coming to work forever and abandons their job, that's a quit. But leave of absences, those will be adjudicated as a voluntary quit because the employee is the moving party that separated themselves from work. And then in lack of work, right, we've got, of course, layoffs, staff reductions, positions eliminated. But seasonal work, temporary jobs, contract hires, reduced hours, those also all fall into lack of work. So let's talk about each one. And before I get started, I do want to stress that unemployment is not black and white. Unemployment adjudication is very gray and every detail matters. So what I want to do is I just want to walk you through the logic and the reasoning and what the state is looking for, and kind of give you some examples, and just arm you with some best practices so that you know that you're giving every claim your best, shot at getting reduction in costs. So let's talk about discharges first. So in the event that you must discharge an employee, the burden of proof will be your responsibility. Now, earlier we discussed that unemployment is for individuals who found themselves unemployed through no fault of their own. In the case of a discharge, the employer will need to prove that the employee was separated for misconduct in order to be relieved of charges, okay? So you have to prove misconduct. The state defines misconduct as a deliberate and willful disregard of an employer's interests or repeated violations of a known company policy. Now, keep in mind, it is very possible for an employee to be discharged for cause and it not meet the state's definition of misconduct. So in essence, you could have made a perfectly good, solid business decision per your policies to separate this person, yet they might still qualify for unemployment. Doesn't mean you did anything wrong. It's just how the laws work. So what I want to do is walk through some of the trickier types of discharges that are generally not considered to be misconduct. So first, let's talk about an isolated incident, okay? So if the individual is terminated for a policy violation, but they didn't have any prior warnings for a similar infraction, the state is often going to rule this as an isolated incident of poor judgment. Now, the exception would be if it was gross misconduct, so like theft or violence, you don't need prior warnings. But for any general policy violations, you're going to have to show that they had at least one prior warning for a similar infraction. Now, where this tends to get tricky is that if you have a progressive discipline policy, so maybe you have if you get so many warnings or coachings within a certain time frame and then you get one more, you're going to be terminated. And that's pretty common. I think most companies have policies like that. So, but what happens sometimes is that the final incident that causes them to get that separation doesn't align with any of the previous warnings. And so then you kind of got what we call a mixed bag. So, for example, if someone was warned, had a verbal warning for attendance and a written warning for attendance, and then they had a final warning for, I don't know, inappropriate attitude or something, but then the final incident was, that caused the discharge was a violation of your, social media policy or something. Again, it doesn't matter that they had all these warnings. Unless that final incident was gross misconduct, they would have had to have had at least one prior warning for something similar to a social media policy violation. So basically what the state is looking for is that the person knew that their actions was going, could cause their termination. So that's what they're looking for. The next one is what we would call a good faith error. It's kind of similar, but not really. So usually with a good faith error, it's, there could be no prior warnings usually, but there could be prior warnings. It's just really more about, was the person doing something that may have violated the policy, but at the time they thought they were doing what was in the best interest of the company. So a couple of examples of this used to work, and both of these examples happen to be involved with this very, very large popular retailer, discount retailer that we would all know. They have a lot of interesting rules because they are very susceptible to lawsuits and things like that. They're a target, high risk, for that kind of thing. So they have very specific rules for specific reasons. And so like one of the ones that we used to see a lot were meal break violations. So for like hourly employees, they're required to take a break, whatever the rules are there per the state. And what we would see happening was this person would fail to take their meal break, and maybe they'd been warned before, but if the line was out the door and there was nobody to cover them, and they were like, I couldn't leave all these customers hanging, I had to wait on them, and that, nobody ever came to relieve me, and so time just got away from me. The employer, because of laws and rules, they have to terminate the employee because they're violating the policy, but the state's going to say, yeah, but that doesn't really count. They were doing you a favor by trying to make sure that these customers were served. They thought they were doing what was best, right? Another example of that same company was, and this is one that I saw specifically, was loss prevention. So their loss prevention team is supposed to be watching for theft in the store, but they have a very strict rule that you cannot approach them once they touch the parking lot. So they have to be on the sidewalk of the front of the building or inside the building. Once they touch the sidewalk, you can't approach them. And there was a loss prevention, and this is a zero tolerance policy. And there was a loss prevention individual. He saw somebody take something. He was 100% positive that they had merchandise on their person. And he went to go up, apprehend them, but he couldn't get to them in time. And in the heat of the moment, made the decision to approach them after they'd already stepped into the parking lot, right? Because they were positive. They knew that this person had been stealing. Well, unfortunately, that person had to be terminated. But the state's going to say, yeah, again, we get that that was your policy, and yes, he violated a policy, but really there was no ill intent there. It wasn't deliberate misconduct. Next one I want to talk about is attendance. Attendance is very frustrating because, we need people to be at work or we can't run companies and businesses. But unfortunately, with attendance, it often is going to come down to the reason for the final absence or tardy and whether or not it was within the employee's control. So if someone calls in properly per your policy and reports that they are sick or their child is sick and there is no way that they can come to work, in most of the states, you're going to have a hard time winning that. There are some states that have like they'll recognize like a points policy, like a no fault points policy, but most of them are not going to. They're going to look at, okay, that final incident was they were sick. Doesn't matter if they had 100 absences before that. You can't help when you're sick. If you're sick, you're sick, right? Now, where this gets gray is, if there was a policy violation on that final incident, that's what you need to focus on. So maybe this person was sick, but maybe they didn't properly report it per the policy. Maybe they're supposed to contact their direct manager and speak with them directly, but instead they texted their coworker, Barb, and said, hey, Barb, can you let Bob know I can't make it in today because I'm sick? That would be a policy violation, and you could focus on that. Or maybe your policy requires certain types of absences to have a medical note, or maybe whatever it may be, they have to call an hour before their shift starts or within 30 minutes of their shift starting, and they waited halfway through the day to call. There could be a number of things, but again, you're looking for a policy violation that was within their control versus something like being sick that is outside of their control. And it's also really important with attendance that you actually track the reasons provided because they actually matter. So like for tardy people, if they say that they overslept, their alarm clock wasn't going off, things like that, those would be considered things like within the employee's control, right? Whereas maybe a flat tire might not be. So, it is important to track those things. You need to ask why the person, you need to record why the person says that they're not able to come in. The other thing about attendance is, here's what I would say. Always provide, because it is so gray, provide all the details and documentation, your policy, the warnings, everything. And we're going to talk about the documentation here in a minute, but provide all of the documentation and let the state make a determination. But when that determination comes back, if the facts are not in dispute, they're not in conflict, and the state says there is no misconduct, do not appeal it to a hearing, because you're not going to change the state's definition of what is misconduct, right? Now, if the facts are in conflict, because remember, there's two sides to every story. The employee's got a story, the employer's got a story, then you might want to appeal. So it's going to be on a case-by-case basis, but I would say in general, provide all the info. Don't just give up and say you can never win attendance, because you can. It's very gray. But if you don't win at that initial stage, I would not appeal it to a hearing unless there is some sort of conflict there. I do see that I think there's questions in the questions box. I'm going to finish this last one and then I will check that. The last one is poor performance. This one gets a slide all of its own. Okay, so one of the more confusing, if not controversial, separation issues surrounds a worker who is discharged due to poor performance issues. But an easy way to think about this is wouldn't versus couldn't. So the worker wouldn't do the job or the worker couldn't do the job. The state feels that it's an employer's responsibility to choose the right person for the job, and warnings will not make a performance issue misconduct. If the employee has never been able to meet the performance standards of the job, it will be deemed as inability to perform the job. There will be no misconduct. Now, there are situations where a worker has been performing at acceptable levels for a reasonable amount of time, maybe a year or 2 or 3 or 4. But then all of a sudden they develop performance issues. This is a different matter. If the worker's job duties or position have not changed, and you can show through prior performance evaluations that this individual historically was able to meet the standards. So again, the job duties cannot have changed or can't have been promoted. But if they're doing the same job and you can show at least one prior performance appraisal that says they met the expectations of the job, then you have, in a sense, proved this person has the ability and for whatever reason is not performing the job. They're purposefully being neglectful. Now, in these instances, I would highly recommend avoiding the term unsatisfactory performance at all costs, because the states, as soon as they see that word, they just close their mind and they just open the checkbook. They start writing checks for benefits, okay? So if you can find a policy violation on that final incident, focus on that, right? Because here's what happens, and we see this all the time. Companies use unsatisfactory work performance as like a catch-all. Maybe they don't have a lot of really specific codes to use, and so they just sort of use unsatisfactory performance to explain everything. Or their HRS system just has a very limited number of codes, and so a lot of things tend to get lumped in here. Well, I can tell you the state unemployment agency doesn't care at all what your HRIS system says or how it's coded in your system. They care about the details and what happened because they're trying to apply the details to the law. And so just because your system says unsatisfactory work performance doesn't mean that's what you have to send to the state. They're not going to go check your systems to make sure you're telling the truth. Like that's not how that works. So basically, you should read the details of what happened and then make a better determination of what description should be sent to the state. It's okay if it's in your system as unsatisfactory performance. But if you know that this person's been working for you for a number of years and they've had successful performance evaluations in the past, well, it's time to be creative here and figure out what's going on. If you can't find a policy violation to focus on, then you could use terms like misconduct-related performance or deliberate unsatisfactory performance. And that way you can sort of shift the mindset to it was intentional. It was not a lack of ability. So let me give you an example to illustrate the difference between something that might be deemed misconduct versus poor performance. So let's just say you hire an employee and part of their job duties involves them driving a company vehicle. And of course, you have a company policy that says, well, if you have a certain number of vehicle accidents, it's going to result in termination. That's fair, makes sense. But I can tell you that doesn't matter how many accidents this person might have had. You could never prove that someone intentionally had an accident. They intentionally drove their car into another car. Like, who would do that, right? They're just not a very good driver. The word accident in and of itself provides that it was not on purpose. It was an accident, okay? Now, on the flip side, if the employee was texting while driving and that's what caused the accident, or maybe they had someone in the car with them and they weren't supposed to and they were distracted. Maybe they were under some kind of influence. Maybe they took some cough syrup, some NyQuil, and they were really drowsy and they fell asleep at the wheel. Those would be examples. Any policy violation that you could focus on that caused the accident versus focusing on their lack of driving skills. So I know it would be just human nature to be like, well, our policy says if you have 3 vehicle accidents, you're terminated. And this person had 3 vehicle accidents within 6 months. Okay, they're accidents. But if you instead say this person knows, that they are supposed to be clear of mind and not on any substances when they're driving, or they're not allowed to be on their cell phone while they were driving, and they were found to be texting and driving, or they fell asleep at the wheel due to taking a substance. That is what you should focus on. So that would be a good example of that. The other thing I want to talk about, same topic, is key terms. And I've kind of already touched on this, but just when you're explaining it to the state, just be really careful about your language. If it is misconduct, if it truly is, and you feel that it was, use language that illustrates that. And so what I mean by this is, again, these adjudicators are not, I mean, they're just clerks essentially that are like looking at a handbook that says, well, if this rule, if this applies, adjudicate it this way. And if this applies, go here. So they're looking for key terms. They're looking for clues about what happened. And there was a really good example. We used to handle claims for a company that had a call center. And one of the policies generally in a call center is something called call avoidance. And they had terminated an employee for call avoidance. So he'd been warned before, had been deliberately avoiding calls, wasn't doing his job. He's a customer service rep. His whole job is answering the phone. So if he's not doing that, in essence, it's misconduct, right? So the employer won the claim initially, and then the claimant appealed, and it went to an unemployment hearing. And when we got the decision back, the state had overturned it in the employee's favor. And they put in there, by the employer's own admission, the claimant's, quote, mistake was staying away from the phone too long. So because the employer in the hearing used the word mistake, it went from okay, Jimmy is deliberately avoiding incoming calls to, oopsie, Jimmy accidentally stayed away from the phone too long, right? I mean, it seems so silly, but that really is exactly how the states read these and adjudicate them. So keep key terms in mind. Last thought on poor performance would be, if you have someone that is not performing to the standards of the job, it really is best, if you can, to separate them as quickly as possible. We talked earlier about that base period, first 4, last 5 completed quarters. If they're a bad hire and you're like, yeah, this isn't going to work out, if you separate them very quickly, you may not have any liability in that base period yet. If they go out right away and file a claim, all their charges might get charged to their previous employers, even though you're the one that's responsible for separating them. Or if they have worked for you for a little while and maybe you have some wages in the base period, maybe you're company A and you've only got 10% of the liability. So just keep that in mind when determining when it's time to kind of make the call that it's time to separate somebody who's not performing, you know, why not refill that job with someone who's going to be capable of performing the job more quickly? So before I talk about documentation, I'm going to look at the questions box because it looks like we have some. Okay, so the first question was, how is claim cost controllable? So the way that claims are, and I did say somewhat controllable, is exactly what we're talking about right now, are the tips on how to prevent inappropriate claims being paid. Because again, the state is taking two sides to the story, and if you're not diligent and properly handling your claims and providing the appropriate details and documentation, you are going to be paying benefits for individuals that you should not be paying benefits for. So that's really the main crux of it. And the other thing, again, is looking at your organization and versus, which is more financially advantageous, whether it's tax paying or being self-insured and reimbursing. How long does a former employee have to file a claim? There's not a time limit on it, but the base period is established on the date that they file. So if that makes sense. So, if they left somewhere and then they waited, to file a claim, they're changing the base period. They're changing the period of when the state's going to look back. So, if they wait too long, it's possible that, there could be no wages there left. I mean, it really all just depends, but there isn't like per se a time limit. The states do say that the employee really should file the claim as soon as they're separated, or if they were given severance in some states, maybe after that. But there's no specific time limit. But their qualifications all depend on the date they file, and that at that moment establishes that look back or the chargeable period, which determines their eligibility and how much they're eligible to collect. And so, by the way, on that note, you could receive a claim up to 18 months after someone leaves your organization. So if you think about that first 4 of the last 5 completed quarters, it is possible to see claims that far away. So hopefully that answers your question. Another question. What is the difference between misconduct versus lack of performance? Okay, and what are the impacts of each separation? So I do think that I've covered that, and but if not, feel free to let me know. What about an isolated incident that causes significant monetary loss to the company? Alternately, not terminating the employee will result in significant loss. Okay, that's tricky, but here's what I'll say. Again, if it was not intentional, then you're going to have a hard time. So if they made an error, like was a legitimate mistake that caused the company a lot of money, that's going to be inability. You made a bad hiring decision. They weren't qualified and they weren't good at the job, right? But if they were doing something intentional, right, like something shady, maybe, I mean, obviously embezzlement would be extreme, but there are other cases where someone might be doing something, time card adjustments, or something that was intentional and they knew they were doing it, then that would be a different story. I think that could even be considered gross misconduct. So yeah, I think it just is going to come down to intent. And again, the financial loss to the company is not the issue. It's the intent behind the person who did it, whether or not it was intentional or an accident. Okay, how does mental health factor into sickness and attendance? So I would say if they have medical documentation, it's very possible that the state could say, I don't know, they were having an episode or whatever, it was beyond their control. But you're kind of getting into fine territory there between the line of being disabled versus just having some illness issues, right? So again, very gray, but it's going to kind of come down to like, if they're not mentally able to perform a job because they have mental health issues, that could disqualify, they might be eligible based on reason for separation because it's out of, they can't help it that they have mental health issues, but they would then maybe get disqualified on the back end for not being able to work, if that makes sense. But in general, if it's just like a here and there, it's not a constant thing, but maybe they're bipolar and maybe something goes wrong and they have like an episode and they can get a doctor's note or something to that effect. If it was that it wasn't because they were deliberately not taking their medications right. I mean, so you can see like it really goes back and forth. So you just have to document and then let the state make the decision on that. But I could see that one going either way, depending on the details. Okay, we have a call out line that we transcribe word for word. Oh, and it has saved us in unemployment hearings before. And having exactly the reason the employee gave and what time of day, et cetera. That is perfect. That is great. And thank you for that example. Absolutely. Having the exact reasons, well, A, it's going to capture what time they called, and it's going to capture the reason that they gave. That's fantastic. And then you don't even have to worry about it. You can just provide that to the state and let the chips fall where they may. So great comment there. Okay, back to discharges. So let's talk about effective documentation. So what does the state need for them to effectively adjudicate a discharge and for you to be in compliance with those UI integrity laws? Okay, so first and foremost, they're going to want details of the final incident. This is not a paragraph or 10 paragraphs about every horrible thing this person ever did. You have to be very specific. What was the straw that broke the camel's back? The very last thing that they did that triggered you to say, yes, I'm terminating them. Okay, that's the first piece. Then you want to zoom in on what was the policy that was violated. Okay, and you know, if it was something like just a progressive discipline policy, then that in of itself may be the policy that was violated, right? That they just had too many warnings. But you want to try to find a specific policy if you can that was violated. Attendance, you know, insubordination, dress safety policies, whatever. So zoom in on that policy that was violated on the final incident, and you'll want to provide that policy. And then you're also going to want to have the employee's acknowledgement of the policies. So what I mean by that is you have to prove that the employee should have been aware that this was against the policy. So you do that by either having a handbook acknowledgement from your onboarding process, or maybe they did it like an online quiz. That would suffice as well. You don't have to prove that they actually even read them per se, but you do have to prove that they've acknowledged that they received them and it was their responsibility, right, to read them. Prior corrective action and warnings. So you want to have written, well, you can start with a verbal, but write it down, meaning maybe you don't give the employee a piece of paper, but if you have that coaching conversation, you need to write it down as a verbal warning, and you need to document the date, who was involved, what happened, all of that, just like you would for a written warning, because that verbal warning could save you in the end as having prior warnings. So make sure that you document all warnings and provide those with the claim. Now, the next one, witness statements. Here's what I'm going to say about this. This is completely optional. It's not always applicable, and be very careful about submitting witness statements, because anything that you send to the state for this unemployment claim could become public record to the claimant. So if you are worried about retaliation issues, or someone being threatened because they wrote a witness statement, you do not want to provide witness statements, because the claimant will probably see what you provided. They have a right to it. That's the rules. So it's not worth winning an unemployment claim if someone could get hurt in the process. So just be very careful of when and how you submit witness statements. You know, if it was a manager, that's usually a good, okay. If it's a coworker, an hourly employee, usually not a good idea. Even redacting the name is not a good idea, because if you black it out, A, the claimant probably is going to figure out who was there and know who it was anyways. And B, the state won't use redacted statements anyway because they don't count. It's like it didn't exist. So just don't send them if it's going to cause a problem, I would say. So it's really these first 4 bullets. Details, date and details of the final incident, copy of the policy that was violated, employee's acknowledgement of the policy, and then prior corrective action and warnings. And by the way, the state's going to be looking at your policies, not only to make sure that you followed it, but also that you are uniformly enforcing it, right? And if there becomes some sort of precedent, like if the claimant says, well, I was fired after 10 absences, but Joan wasn't fired, she had 15 absences, you're going to have to answer to that. You have to follow your policies, and you have to uniformly enforce them. So you might think that you're doing someone a favor and that will look good, like good on you, like it will shine favorably upon you if you're like, listen, we really cared about this employee, so we were really trying to give them some extra chances, and we knew they were going through some sickness and some hardships, and so we gave them some extra, you know, attendance, absences, what have you. That actually will hurt you in an unemployment decision, because the state's going to say, well, if you're not following your own policies, how are employees supposed to know what is expected of them and why and when they would be terminated? Okay, so you have to follow your policies. That is super important. Comments about coachings and warnings as well. Always have the employee acknowledge that they received it, or at least try. This is not an admission of guilt. So when you go to have them sign it or sign off, they might not want to sign it. First of all, try telling them this is not an admission of guilt. This is simply receipt. I received this. Maybe you could even put that on the document where they sign. I received this warning. That might make them feel better about signing it. Or if they still won't sign it, you could have them say, I refuse to sign, and initial it. Or I disagree with this, and initial it. Those are other ways to get around it. The other thing too is to have another supervisor or manager or HR present when you do these warnings. That way, if the claimant says, if they refuse to sign, and then in the hearing they say, or the unemployment claim, they say, they never warned me about that. I never got that warning. You'll have a witness that says, nope, I was there and I know that this warning was being presented to the worker. All right, let's talk about voluntary quits. Let me take a sip of water real quick. Okay, in this situation where an employee quits his or her employment, the burden of proof is going to be on the former employee. They're going to have to show that they had good cause attributable to their employer, and they're also going to have to show that they exhausted all reasonable options before making the decision to quit. So, what are some situations that could be considered good cause? So, good cause would be a change in the condition of their employment. So say you hired an individual to work day shift Monday through Friday, but maybe now you need them to work on some weekends or some evenings. That would be considered a change in the condition of their employment if you're mandating that, and that was not agreed upon at hire. Or maybe you have a bookkeeper and your receptionist quits without notice, and you don't have a receptionist, and so you ask your bookkeeper to fill in on the phones, a couple times a week, but maybe your bookkeeper has severe anxiety about talking to people, and that's why they're a bookkeeper. That's why they chose that profession. If you leave them no option but to get on the phone or to quit, the state might say, well, you changed the condition of their employment. You didn't hire them to be a receptionist. It doesn't mean you can't ask them to be a receptionist, but if they can't do it or they don't want to do it, you might leave them no option but to quit, and then they might be able to collect unemployment. So keep that in mind. The other thing is compelling reasons such as harassment or hostile work environment. But the key here is that the employee must have reported it and allowed you an opportunity to address it. So the state does not require that the employer always satisfy the employee. So it's okay. Like the employee could still, you could have gone through the whole process, but the employee was like, nope, I'm still quitting. They'll likely be disqualified in that instance, as long as you can show that you took reasonable measures, that you resolved the situation or took them out of that environment, addressed the issue. That would constitute that the employee chose to quit even, without good cause, basically. So if they just quit though without reporting it to you, again, they've not taken all reasonable measures to preserve their job. And so they would be ineligible in that case as well. There are some provisions, and they vary by state, for certain personal situations. So just be aware of that. There's nothing you can do about it. It just happens. So like If someone is married to someone in the military and their military spouse is transferred to another state, the state is going to allow that person to move with their spouse, of course. And as long as they're meeting all provisions, meaning they're looking for work in their new state, so they're actively seeking employment, they're available for employment in their new state, and also that they made all reasonable measures to preserve their current job. So did they request a transfer? Did they ask if they could work remotely? So those are the types of things that the state's going to be looking at. But it is very possible that if they're meeting all those criteria, that they will be eligible to collect unemployment, even though it's not anything attributable to you. It's just a state law. The other one would be like if they had to flee the area for a domestic violence situation or something like that. But again, they have to meet all the other requirements. They can't just flee and collect unemployment while they sit at home. Like they have to be actively looking for work in their new location, those sorts of things. And the other thing about quits is, and I kind of mentioned it earlier, continued employment must be available. So for it to be a quit. So if it's a forced resignation or a quit in lieu of discharge or a mutual agreement, whatever, it is a discharge. It is not a quit. Again, state doesn't care what your HR records say. So if you're like, yeah, we're going to let you quit and resign to keep your record clean or whatever, you can do that. It's totally fine. But when it comes time for the unemployment claim, don't even try to pursue it as a voluntary separation. It won't fly. Doesn't mean you can't still get a disqualification. You can, but you're going to have to prove misconduct. The burden of proof will shift back to you. It will be adjudicated as a discharge, and you will have to provide the details and documentation as if it were a discharge. Last thing about voluntary quits would be, I want to talk about job abandonment for a second. So job abandonment varies by state. And in most states, it's going to be 3 consecutive no-call, no-shows before they consider it a voluntary quit. Anything before that would be a discharge. There are a couple states like New Jersey and Alabama that require 5 days of no-call, no-shows. So let's just put it this way. Even if your intent was to probably fire them if they came back, or if they tried to come back after that first no-call, no-show, document the next 3 days or 5 days if that's your state. So that way, if they never come back and they truly abandon the job, you have those dates and the shifts they were supposed to work that they never called or showed up for. Now, if they no-call, no-show one time and then they try to come back, you could fire them for attendance as long as, you have all the, they've had warnings. That's a policy violation. They were aware of the policy, that sort of thing. That would be a very good example of an attendance case that you'd be able to win as long as they've been warned before, if they had a no-call, no-show and then tried to come back. But again, for a job abandonment, for it to be a quit and not a discharge, the minimum is 3 consecutive shifts of no-call, no-show. All right, so what kind of details and documentation do you need to be effective for voluntary separations as well as being in compliance with those laws? You don't need a lot. The burden of proof is on the former employee. You really just need the dates of employment, the reason provided by the employee. But I would highly recommend, if you can get a letter of resignation, get one. Even if it's just a text message, an informal email, whether it's a scribbled note, anything in writing that says, this is why I'm quitting. Because believe it or not, they actually change the reason a lot of times when they go file the unemployment claim. So having something in writing is very helpful, but you don't have to have it to be compliant, right? You just need the dates of employment and the reason provided by the employee for the separation to be minimally compliant. If there was a notice period, make a note of that and whether or not you allowed them to work it. So if someone gives 2 weeks notice and you say, yeah, we appreciate the notice, but your job ends today, they will be able to temporarily collect for the 2 weeks you did not let them work. Or if they gave you a month of notice, they'll be able to collect for that month that you did not let them work. They may be disqualified after that for voluntarily quitting, but just understand that you take that risk. If you terminate them early, they will collect for that period. Exit interviews, just a best practice, in my opinion. They get a lot of details and having a good record of why this person's quitting. So it's just a recommendation. And again, if there were any job dissatisfaction or harassment or anything like that, any claims of that, just make sure that you are documenting those investigations. documenting the potential resolutions and what you did to try to help that employee. There's a new question. What if the employer does not respond to a claim in time? Ooh, that's a really good question. So I don't know. It depends on your state. So some states have what we call loss of rights, meaning if they don't get the response in time, you have no say in the claim at all. Meaning they're only going to take the information submitted by the claimant. So like states like Kansas, if you respond, and Connecticut too, if you respond even just one day after the deadline, they are going to completely disregard what you've sent them. Or they may consider it in the decision, but if it's not in your favor, you will have no appeal rights. So I would highly recommend responding on time. I would say always respond, even if you're late, just so that, because it may factor into that initial decision, even if they don't give you any appeal rights. So definitely still respond, but responding late, gives you a ticker mark on that naughty list of not being compliant, which really only affects you if you appeal something to a hearing and try to get the previous benefits reversed, right? But also, so it puts you on that naughty list, but it also could make you lose rights. It just depends on your states. Some states will accept late info with no penalty at all. Some states have a financial penalty, so like a fine. So Maryland, it's $15 every time you respond late or without the pertinent details. Vermont, it's $100 every time you respond late or without pertinent details. So another thing to keep in mind. Good question. Okay, so let's talk about lack of work. Lack of work is the intent of unemployment, right? That's the whole purpose of the program. If someone's job is eliminated, there's a reduction in force, a layoff, any of those types of things, they will be eligible for unemployment. There's no why would you want to contest that? Obviously, if there are some severance issues, we'll talk about that in a minute. But in general, lack of work is not disqualifying. Okay. There are specific things within this bucket that can be protestable. So what I mean by that is you can't protest the separation when it's something that falls into lack of work, but you can question other things. So when we talked about the 5 criteria for being eligible for unemployment, one of those things is availability, and that often comes into play with seasonal workers, assignment-based casual employees, part-time employees. So I'm just going to kind of dive into some strategies for the things within the lack of work sector that you can control or that you can influence, if you will. So let's talk about part-time employees first. So the state categorizes part-time 3 different ways, okay? So the first one is going to be regular part-time. Regular part-time is defined as a worker who works less than full-time, but has the same schedule every week, okay? So for somebody to be deemed as regular part-time, their hours cannot be varying. So if you hire a bookkeeper who works Monday, Wednesday, and Friday from 9 to noon every week, and that's the agreed upon schedule, that would be regular part-time. Regular part-time claims are usually going to be protestable in most states, okay? Now, the other 2 categories, works all available hours. So this is probably going to apply to the majority of the part-time employees that you guys have. If they work less than full-time and their hours vary from week to week depending on business needs, and they're not putting restrictions on their hours and they're working all hours that you're offering them, that's a lack of work, okay? Now, again, that does not mean that they're going to get unemployment, okay? It's all going to depend on how much they qualify for based on their wages in the base period. What are they typically used to earning? How much did their wages go down that week? It has to fall below a certain level, that sort of thing. But we'll talk about some strategies for monitoring availability on those issues. And then the third, but it's not protestable, okay, in general. And then on-call or casual employees, again, kind of similar, but they just work as needed. So maybe in-home care workers, substitute teachers, they have no regular schedule, they work as needed. Again, non-protestable, but availability can be questioned. So let's talk about that. Part-time, went too far. Okay, so regular part-time can usually be protested. So again, regular part-time is that set schedule. So if you provide a set schedule per week, you'll want to know, did the claimant request to be part-time? Do they have restrictions on the number of hours that they can work? The state will ask you that. Has their schedule changed recently? If so, why? Any availability requests to change their availability, you need to get them in writing. So if they're working Monday, Wednesday, Friday, and now they're like, I think I'm going to take this pottery class on Friday. So I'd like to work Monday, Wednesdays, and Thursdays instead. I'm not available on Fridays, or maybe they just aren't going to work Fridays at all, and now they're only going to work Monday, Wednesday. Whatever the change may be, you need to have it in writing. And just know that not all states provide relief for part-time work, but in general, if they're regular or part-time and you're providing those regular hours, they're likely not going to qualify for other reasons. So don't panic too much there. Tips and strategies for lack of work claims for availability issues. So is the claimant accepting all available work or hours? So this is kind of how you can manage this. So let's just say that you have a part-time worker whose hours vary, but maybe they also have another employer. Maybe they have a full-time employer. This person just works for you a few evenings a week. And maybe their full-time employer separates them. Maybe they get laid off. And that's why they filed a claim. And it has nothing to do with you, but they don't get to pick and choose which employer gets the claim. The state determines that, right? So let's say because of all the wages in the base period, you've got a full-time employer and a part-time employer, they probably qualify for a good amount for their weekly benefit amount, but you're still providing part-time work. What will happen is the state will say, okay, this person is eligible based on their layoff from their full-time employer, but then this person is going to have to report their earnings that they're making from you every week to determine if they're eligible. Some states, it's if it falls below their weekly benefit amount. So if the wages you're paying them currently falls below the weekly benefit amount, they'll be eligible for a partial benefit. Some states, it's like the weekly benefit amount plus something, whatever, if it falls below. So it varies by state, but they're basically going to look at that. Now, if someone's working for you part-time and their hours vary and they file a claim because they did lose another job or something like that, the only way to avoid paying unemployment. Now, they could be working for you and you could be paying unemployment. So understand that. It happened a lot during the pandemic. The only way to avoid that is to offer them more hours and have them working more so that their wages stay above that threshold, or offer them more hours. And if they refuse, you can protest the availability of their claim. So again, that's one of the criteria for collecting. You have to be available to work. If you're not accepting all available hours, you're not available. So make sure that you make all, and I know it's a lot to sort of track this sort of stuff, but like with substitutes and casual workers and part-time workers, if they're refusing assignments, you've got to report it. And it gets a little tricky with like assignment-based work because let's say somebody goes in for an assignment, they're working in home care or something, their assignment ends, they file a claim, you get the claim, and you're like, well, it was lack of work, assignment's over. That's a legitimate claim, and that goes back to the state. And then maybe a week later, after you've already responded to the claim, you reach out to that person and you offer them a new assignment. And they're like, yeah, no, I'm not really available for that assignment. I'm going to be taking some, classes at the community college or whatever the case may be, or maybe I'll be on vacation or whatever. At that moment, you're not going to get a new claim. You're not going to get a new claim. So it's up to you to proactively offer that information. Hey, this was a lack of work claim, but this person's availability has now changed and they're not accepting all available work. Another thing would be like with seasonal work. I know it seems kind of odd that seasonal employees might get to collect unemployment, But the reality is that the state is not going to, they're not going to penalize someone for accepting work just because it wasn't permanent work. They want people to accept work. They don't want to discourage them from accepting a job because it's seasonal or temporary. So when that job ends, if they are still available, actively seeking work, physically able to work, but no work is available, they will be eligible for unemployment. So like your Christmas workers at the mall, your summer time hires. There is a specific provision for camps, which I'll get into in a minute. But in general, temporary workers technically are eligible if you're in the base period and they file and they're still eligible. Now, if they went back to school because they're like a college student that was home for the summer, they're not going to be eligible because they're a full-time student. That makes them ineligible for unemployment. So just be thinking about that. Also, you can, as a strategy, you can use your unemployment claims as like a recall roster. So this is what like staffing agencies do. So if you think about like a temporary staffing company, they get tons and tons of claims that are considered lack of work because the assignment is over and they're waiting for a new assignment. So what those staffing agencies do is every week they'll pull a list of all the people that filed a claim in the previous week or two. And when new jobs become available, those are the people they reach out to first. So that's a really good way to sort of manage your unemployment costs and exposure as well, is reaching out to people. Like if you have new jobs that, like if you had a temporary assignment and it's over and something new comes up, instead of just only posting it out there and like on Indeed.com and just trying to get people off the street, you could proactively reach out to that former employee and say, hey, we've got work. If it's of similar, I mean, the state has to determine if it's a bona fide job offer, which would be like similar work, similar duties, rate, pay, all of that. But if it qualifies, right, and they refuse it, well, so either they'll come back to work and stop collecting unemployment. So now you've filled that slot and no longer paying unemployment, or B, they'll refuse it and you can report that to the state and the state can then adjudicate whether or not they feel that that was a bona fide job offer that was refused. So those are some strategies. Again, just to sort of clarify this, when it comes to lack of work, you cannot protest lack of work itself. You can, however, protest regular part-time and you can protest availability. Those are the two things that you can protest when it comes to lack of work. Now, I said I was going to talk about summer camps. A lot of our nonprofits have summer camps. Certain states exempt camp staff from unemployment coverage. So if you meet these criteria and you're in one of these states, now this doesn't mean there couldn't be other states. These are the states that we are aware of that do this. But if you hire full-time students, they are employed less than 13 weeks, and the camp operates for less than 7 months a year, then your camp staff, if they meet these criteria, are not eligible for unemployment. And in addition, you need to exclude their wages from your quarterly contribution reports to the state. Otherwise, you will pay benefits. I mean, if they're a full-time student and they go back to school, you'll probably be okay because they're a full-time student. They either won't file or they'll be disqualified that way. But I'm just saying it causes confusion on the state's end. This happens a lot of times with like other categories like AmeriCorps employees, for example. Again, they're not eligible for unemployment. But if you send those wages to the state on your quarterly report as subject wages to unemployment, and then you turn around and say, oh, it was the end of a summer camp or the end of a temporary job, there's a good chance that the state will start paying that person because they're seeing it as a lack of work and you've reported the wages as being subject to unemployment. So just know the rules in your state. If you have one of these camps and you're in one of these states, make sure that you're excluding these wages as they are not eligible and should not be on your reports to the Department of Labor. And then another tip and strategy for lack of work claims is understanding the rules of severance in your specific state. Okay, so it depends on what your goals are. If your goal is for someone to get severance and get unemployment, or maybe your goal is for the severance to offset unemployment, it just depends on what your goals are, but just understand the rules for your state. It does vary. And also how the severance is paid can also make a difference. So again, this goes to the rules of your state, whether it's allocated out into multiple payments, whether it's a lump sum payment, or whether it's like a lump sum payment and you say it represents this number of weeks, that all can factor in. And then again, there are certain states that do not consider severance to be wages. And so if you're in one of those states, and I'm not a payroll expert, so let me be clear on that. These are things that I've run into in my experience that I've researched and I know about. I don't know every state. I don't know the rules. You would have to check for yours, but I do know this to be the case. This is like a payroll issue. If your payroll company reports the severance in a state that does not consider it to be wages, they might use that severance pay to requalify someone for unemployment. So I actually saw this happen once and it was really unfortunate. So here's what happened. Someone filed, this was in the state of California. So that is the state that I do happen to know does not consider severance to be subject wages or covered wages. And therefore it does not come off of unemployment. They can collect unemployment and severance, but it also should not be reported to the state. And so here's what happened. This person was let go. And, it wasn't disputed that the person probably should be eligible for unemployment. So she was eligible. She collected her full maximum unemployment benefit amount. Unemployment claims are good for 1 year from the date they're filed, or until they hit their maximum benefit. Okay. So then once that 1 year is up, then they can open a new claim. And they then would establish a new base period. So what happened was when the person originally filed their claim, this employer was in the base period. They were also the person that the company that let them go. They paid 100% of the benefits because they were the only employer. And this person maxed out. And then when the next year came and this person was still unemployed, they opened a new claim, which then started a new base period. And that employer would have had no wages in the base period and would not have had to pay another claim, except for the fact that they reported the severance. And the severance was paid out several months after this person left and was reported to the state. And so the state saw wages and then requalified this person. And so not only did the employer pay this person severance and a full $11,700 unemployment claim, but then the next year got found responsible for yet another unemployment claim based on the severance payments. So just be really careful if you're in a payroll capacity. Just know the rules in your state and understand how that impacts things, because that's another way to control unnecessary expenses. And again, it doesn't apply in every state, but I know for sure that that's how California views it. This employer had to go back and basically amend their previous quarterly wages, or their quarterly reports, basically, is how they fix that. And then the last tip for lack of work claims would be to consider using reemployment or outplacement services. You may not realize that these services are included in your membership with 501. So if you're a member of our organization, you have reemployment services included in your membership fees. So at no cost to your organization, you can provide these packages to separated employees. Now, who qualifies for what level of package is dependent on if they're a full-time, longstanding employee, and they were let go for no misconduct, or if it, basically there's a base level package, like the online package that is available to any separated employees, and you can have as many of those as you want, and it could be for any separation reason. But then you get 20 packages a year at no cost to you for the enhanced one-on-one coaching, that type of thing. For employees that are let go due to no misconduct and are permanent full-time employees that you've had to let go. So if you're planning a layoff, if you're planning to have to cut jobs or anything like that, reach out to us. We can help you do some forecasting on costs. Of course, those would be rough estimates, but we can help you with that. We can help you get connected with those reemployment services and packages to help your separated employees find their next opportunity quicker, which is going to reduce your unemployment expense, as well as just help that person and ease them through the anxiety of losing a job. So just know that those services are available to you. All right. Last but not least, tips and appeals for hearings, and then I'll go back to the answer any final questions. Okay, first thing to know about unemployment hearings is that firsthand testimony is critical. So if you send someone in HR who is not directly involved with the separation and you don't send the supervisor that was directly handling it, it's going to be considered hearsay. Your testimony will be hearsay. Whereas the claimant is going to be there testifying for themselves. Their more weight is going to be given to their testimony because it's firsthand. So that you can have as many witnesses attend as you want. Just make sure at least one of them is a firsthand witness if possible. Obviously, if that person has left the organization, nothing you can do about that. But when possible, make sure firsthand testimony is available to participate in the hearing. Another thing, try to remain calm. These things can be really frustrating because the claimant might just be saying all kinds of things that are completely untrue. You might have a biased judge that's cutting you off and being rude. I mean, there's a lot of things that can go on in these hearings. So I would say that the best recommendation is to remain calm, address only the facts. Be sure to rebut the claimant's statements, but don't interrupt. So what I mean by that is have a notebook handy or a piece of paper handy and a pen. And anything that the claimant is saying that you want to make sure you circle back to and rebut, write it down. So then when they're done speaking and it's your turn, you can make sure to go back and rebut those statements. But just do not interrupt or say that that's false or get emotional during the hearing. Also, when I say address only the facts, you want to be very clear. Again, this is not a dissertation on everything this person ever did to get separated. The state is going to want to know what was the final incident. Then they're going to want to know what policy was violated and how this employee was made aware of those policies. And then they're going to want to know about the history, what led to the separation. And that's when you can talk about prior warnings and history. Don't pull it into the final incident. It only muddies everything and it will confuse the judge, and it's not what they want to know. Also, be very careful about including things that happened after your decision to terminate. So what I mean is, if you are under the impression that someone who gets angry while you're terminating them and curses you out and throws a chair across the room, if you're under the impression that that's going to help you win the case because it makes them look like a bad person, you are wrong. State does not care about what happened after you already decided to terminate them. It has nothing to do with why you fired them. It might speak to their character. It might have a place somewhere in the hearing when you're going through the storyline, but just know that's not your smoking gun and that is not what you should be resting on because it has no relevance to their actual termination. It happened after you had already decided to fire them. And then making a closing statement is very important. And I say this because, you know, things will get muddied back and forth, back and forth. This is your opportunity to readdress, net it out, and restate why you think this person should not get benefits. And then last but not least, utilize hearing representation services. Again, these are included in your membership. When you get the hearing notice, you just have to type in the box that asks about this. Yes, I would like a hearing representative. They will assign you a representative that will attend and participate with you. They will help with they'll always prepare you, even if you don't want someone to attend with you, they'll always prepare you, but they'll attend with you. They'll make sure to handle the cross-examination if you'd like, or the summarization of the facts at the end, the closing statement. So work with your hearing rep. They're very experienced. They really know what goes on. So if you'd like that assistance, make sure you utilize it because it's there for you as one of your benefits of being a member. So that's all I had for today. I'm going to go check the questions box. It looks like we have some more. You guys are very engaged, and that is awesome. Okay, what do we got? Okay, what if the employee files and our company is shut down because of damage caused by a hurricane? Same as lack of work. Yes, that is correct. Basically, if they're filing because your company is shut down for a hurricane, that would be lack of work. It is a natural disaster, and they would be eligible to collect. I don't know if your question is more geared to what if somebody's filing a claim from, they left a year ago and well, if they left a year ago and you're a base period, in most states you wouldn't have protest rights anyway. But let's just say you're in a state that you can and it was, misconduct. Unfortunately, if you're not in the office because it's shut down to respond, the state will likely move on with the claim. You could probably try to appeal it later and show you had compelling reasons why you weren't able to respond on time. Probably be a little bit tricky. But yes, companies being shut down due to hurricane damage is same as lack of work. Unless they can work remotely. So if they're able to work remotely, then they should be working remotely. How to report a work refusal to the state. Hey, great question. So everyone on this call today, I believe, should be a member of our organization. This should be a members only webinar. So there is a platform that you use to communicate on claims called Shield. And within that platform, there is a link on the left side menu that says report a job refusal. All you have to do is click that link. It will ask you the specific questions that the state is going to need to adjudicate whether it's a bona fide offer of work. All you have to do is fill that out and hit submit. And then Thomas and Company, our claims administrator, will take care of making sure that protest gets to the state. It's a lot harder when you're on your own, right? If you're not using a TPA, you're going to have to remember what address and where you sent the previous claim to, and you're going to have to basically send a follow-up or an addendum to it. But you should be a member of ours, and if you are, there is a link within Shield to report those, and it's very easy. California employee was given 2 weeks severance at the time of separation. How do I not report that? So what that means is, first of all, it doesn't matter if you report it to the unemployment office or not, because as far as like on the claim itself, because it won't impact their claim. California does not view severance as wages, and so they can collect severance and they can collect unemployment, so it's irrelevant. Now, when it comes to the payroll company, you have to code it in a way that and I don't know exactly how that works because again, I'm not in payroll, but there's a way to show that it's not covered wages. Just like if you were to hire an independent contractor, somebody who is actually an independent contractor, that would not be covered wages. It's the same idea. You would not have your payroll company, or you would code those wages in a way that indicates that it's not covered employment, so that your payroll company will not include that as being subject to unemployment. That's the best explanation I can give you. And unfortunately, again, I'm not in payroll. I just do unemployment. So that's the best I can tell you, but hopefully that helps. Will we have access to this recording? Yes, you will. So you will get a copy of the recording after the webinar, I believe. You will get automatically, it will send it to you. So yes, so let me reiterate, if you attended this webinar because you are looking for those SHRM or HRCI credits, then you will get a survey sometime after this webinar. You have to fill it out and then give us about 24 hours or so to get you those credits. And we'll send you a code. So that's all you got to do, fill out the survey. Okay. Well, that was it. Again, there's a copy of the presentation in the resources section if you want to download it, if you haven't done that already. And with that, I'll close today's webinar. I want to thank everybody for attending. I hope you learned something. I hope this was helpful. I know there's a lot of exceptions and a lot of state-specific rules, but that's what we're here for. So if you have questions, lean on your support here, and we will do our best to make sure that we get you what you need. So thanks a lot, and everybody have a great day.